Last year was a very challenging year. We had a deal that we went after in late 21. We lost it, tried to going in 22. With interest rates changing so much so fast, we weren't able to make that make sense and lost a bunch of EMD and whatever else. Last year, we went after a couple of deals. We couldn't make them work.
Real Estate Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. Today we are joined with JP Albano, future best-selling author and CEO with $60 million in assets, leverages 20 years in IT and real estate expertise to guide professionals in passive investments through his upcoming book and podcast. JP, we're excited to have you on the show today. If you could let the listeners know a little bit more about yourself.
Awesome. Thank you, Josh. Glad to be here. So I've been in tech for 20 plus years. I was in tech sales for about 10 years or so, found a lot of success in that. Been very, very thankful for doing that, selling to big enterprise companies of sorts. I kind of realized partway through, even though I was seeing success, I was kind of bored with the job a little bit. And then more importantly, I was frustrated with how much I was paying in taxes. And so I'm like, all right, there's got to be a better way, right? I want to pay half my check out to taxes. And so long story short, I found real estate, I found apartments. And for me, apartments made the world of sense. Everything about it, everything just about the economics of how it works, the dynamics. Loved apartments. Got some training, got involved, found a partner. Fast forward a lot of years later, grew to over 700 apartment units across 3 different states, vertically integrated, blah, blah, blah. Now I help other tech sales professionals learn how to take the money they make in sales and parlay that into real estate with low risk investments, to be able to diversify their W-2 sales income and then create a life for themselves where they're not tied to their sales job. So that's what I do now.
That's huge. And I say it's huge because you can now help what would be other co-workers in a space to where
exactly
they're concentrating on exactly what they're supposed to be. And that's creating the future softwares for many to use. Yep. And at the same time, you can help them take in that extra cash, put it towards hard assets like real estate. And now that money is now earning more money.
Exactly.
Money for them.
Yes.
That's great. And and you've managed to scale pretty quick. Can you tell us your journey, where you started at that first acquisition, and then the learning lessons along with it?
It's amazing how everything's a learning lesson. And as I get older, the more I keep not reminding myself, but that becomes very self-evident. Like I have an idea of how this will work out. Never out that easy. And then, you'll kind of learn along the way. So when I first got into real estate, after doing a lot of analysis on like how to find a market and all that stuff, I realized I didn't know what I didn't know. I didn't know how to actually do underwriting. Like I knew how to pick a market, like that was kind of easy, but like, how do you underwrite a deal? What are the best practices? And so I sought out education back in 2017, 2018. The world was a little different. It was a bit harder to find real estate educational groups, even though that wasn't that long ago. It still feels like it was that long ago. And I got involved with the great guys at Jake and Gino Wheelbarrow Profits. So I joined their educational program, found a partner, and right around the same time, I also became a KP or a key person in a real estate deal. It was a 42 unit in Houston. Went out to Houston, go check out the asset, and I was basically a limited partner investor in that project. It was like $75K of an investment. I got a little bit of extra general partner upside for that. And it was my first opportunity to kind of see what goes on behind the curtains as a real estate investor. As a passive investor, I wasn't the one doing the actual deal pieces, the day-to-day, but they were keeping us involved early on with what we needed, what we could help with, and those sort of things. But it really whet my appetite because I realized this is kind of fun. And I found the real estate investment world so much more welcoming than the sales world. Like, as my sales guy, my role, I worked as a account rep for a reseller. So we didn't make any product, right? We would resell Dell or HP or whatever. And I managed the relationships with my client, the end user, and also the manufacturer sales rep. So I felt like I was constantly herding cats. And it was a constant, drag on my soul a little bit sometimes. And when I got into real estate, it was such a more welcoming world. Like everyone wants to partner. Everyone realizes you can't do this by yourself. Like you need a team. It takes a village, right? So that was really encouraging. And then I got myself into an opportunity where me and 3 other basically strangers, we were put together to have the opportunity to buy a 28 unit 1970s build apartment complex in Houston, Texas. One of the partners was local there, and we syndicated. That was our first deal that we were active investors. We syndicated it, which, going back, I don't know if that was a good idea or bad idea, but it was a lot of work. There was a lot of personal limiting beliefs I had to work through. Changing careers from tech to tech sales was one thing, then from tech sales to real estate investor, and then entrepreneur. Like there's a lot of things you overcome. I'll give you an example.
Yeah.
One of them was raising capital from friends and family. Like in the beginning stages, I was looking at it as if I needed something from them. And then ultimately I kind of realized I'm bringing them an opportunity that they wouldn't have otherwise, an opportunity to invest in something to further enrich their life. And so that took a bit of time to kind of overcome and get through, but there was a lot of growth moments that happened, in those very early stages and early years in getting comfortable with identifying myself as a real estate investor. There's more, but I'll stop there.
No, that's perfect. That definitely gives us a lot of context because you started small, which is now it's small. To others, it could be huge because it's still a large complex.
Let's talk about that. There is this crazy thing in all of us, especially when you get into real estate. You think about, I think what happens is like, what is achievable for you, like your own personal thing. For me, I think everyone can realize like, yeah, I can go buy a house. I can go rent that out because you've done it before. You bought a house before, chances are. And you can conceivably see yourself buying another single family house and renting it out, or a duplex or a quad. Like that's easy. But then suddenly when you get to like a 12 unit or 20, you're like, okay, wait a minute. That seems like a lot. I don't know. Like it's really complex. I remember having a big hang up and like seeing these deals, 100 units, 200 units, 300 units and going, that blows my mind. Like that would be JP 30 years from now. Like I can never achieve that just yet. And I remember last year I was looking at a deal. It was 1,061 units, 10,1061.
Wow.
And I was talking to the brokers. I was getting information about it, and I had to stop myself. And I'm like, do you remember, like, wasn't that long ago that you had a lot of apprehensions about looking at a 50 unit apartment? And here you are looking at a 1,000 unit apartment complex. It wasn't a portfolio. It was one complex with 1,000 units. And so it's all in your mind. And the big takeaway that I learned along the way was, and I think you're familiar with this, is like, it's the same brain damage, whether you're going to do 1,000 units, that's a bit extreme, 300 units or 20 units, the payoff is a lot better with the large units. So think about that.
Big time. And you still do go through all of the same motions as far as purchasing it,
Yes.
But the numbers are much bigger. The diligence is obviously a lot more, the due diligence. The process is just more extensive, which requires more people.
Yep.
But the process stays the same. There's not a whole lot of complexes that are over 1,000 units. Was that Midwest?
No, it was in Florida. It was in Florida. It was in Tampa area. It was really cool. It had boat slips on it.
Wow.
It was really interesting.
There was a 980 unit that came. It never surfaced. Usually those don't surface. Those are usually pocket deals.
Totally.
But
Totally.
I mean, just driving through it, it was in distress. But just driving through it is absolutely surreal because it's an actual neighborhood. It's like a town.
It's a town. It's a town. It's essentially a town. Yeah, you need to have like 2 or 3 property managers for the area because one person can't do that.
Divide and conquer. You have different segments, and then even like putting in a car wash, convenience store. I mean, because you have the masses, so we're like, we can plug these other verticals in and create additional cash flow. So it's very surreal that driving through a complex that big and very cool.
It's cool.
And then as far as like KP, key principal signing on the loan, you brought the net worth, your balance sheet, and then that got you a piece in the general partnership because you essentially made them now eligible to even get the loan. So you brought some cash because they're running the deal, plus you signed on the loan. So you were on both sides, which is a cool experience in itself, especially on a first deal.
It is, and it's something that is not extraordinary. It's outside of, I think, most investors' purview of like what's possible. There, in this world in real estate, there's a lot of creativity that you can apply, right? As a sponsor, you might need some help with net worth or liquidity requirements to qualify for the loan. And if you're an investor and you've got cash and you've got it, but you don't have the time, like there's an equal exchange of value there. Like, hey, look, I've got cash, but I'm really busy in my sales job, making money, or whatever your profession is. I can help you in this way. And there's a way the sponsors will make you whole on that. They should be able to provide some upside for you, or cut you a piece of the deal so you can be part of it. But there's just so many different ways that you can be involved and add value and earn returns as part of that.
Yeah, there's a saying, keep the main thing the main thing. So you're making your money and doing X right now. That's making you money. Don't quit that thing that's making you money to now go do it real estate, because now that drops off. keep the main thing the main thing.
Yep.
Add real estate on as a vertical. Find a person who can get you there and start to compound.
Amen.
Tell us about the second deal, because first deal usually comes in threes for whatever reason. After your first deal, then it just starts to snowball.
Yeah. So the second one was I was in the process of relocating from New Jersey to Georgia, and we got access to my coach at the time got called from broker because he was down here in Georgia. It was an off-market 12-unit complex. It's 2 6-unit buildings, basically. 2001 build in a suburb of Atlanta called Austell. We bought it we negotiated the price. The seller wanted a little over $1 million, and we got him down to like 970. And what I didn't realize was if we would have gotten down a little bit lower, we wouldn't have qualified for an SBL loan from Fannie Mac, one of the two. And so then we wouldn't have been able to get a low interest rate loan on it. So you got to be a little careful. There's a cutoff if you're going to apply for a Fannie Mae or Freddie Mac loan for those small balance loans. But whatever, we got it. We got a loan on there. I think we put in we raised 200 grand of equity from a number of our partners that were in the same educational group, and we bought it, and the rents were under market by a couple $100. We still have it today. Fast forward 3 years later or 4 years later, whatever it's been. It works pretty well. I mean, managing a small unit compared to, our largest we have is a 278. It almost becomes a distraction to a degree.
Yeah.
So, and in the beginning stages, I don't want to say any deal is a deal, but like you kind of don't care because you just want to get going. But then there does come a point where you start to outgrow those. And it really comes down to what your plans are, right? If your plans are to find a niche where you want to operate in the smaller apartment space, there's nothing wrong with that. It's all good. You can be very successful and make a lot of money doing that. But if your plans are to kind of get to the big ones, those little ones will kind of steal your time a little bit, right? Because a problem there is still a problem, right? And, what's the risk time reward on that? So that was our second deal that we did.
How are you managing these as you're building them up? Is it third party?
No. So in the beginning, it was third party. When we had about, 100-ish units, we were frustrated with our third party PMs that we were working with in our various properties.
Yeah.
And I'm from New York. I'm Italian. I talk with my hands, right? You want to shut me up, just put my hands in my pocket. I've learned that no one cares about your baby as much as you do. That's my experience. And so no one was moving with the same sense of urgency that I have. Units weren't getting filled. And so my partner and I were like, why don't we just take on property management ourselves? So we did something that I wouldn't recommend most people do. Start a property management company with 100 units or less. It required a lot of self-funding to get going, but that was just investing in a team so that I didn't have to be the one doing that. And so we ended up starting our own property management company, which helped us later on because when we found our future mentor, it turned out like that would be the best thing for us to be able to have full control of our properties and our team and how we train them and how we onboard them to operate our properties. But it's a whole job in itself.
Yeah, amen to that. And I'd say it's a blessing and a curse because we've got full control of the performance. At the same time, you're stuck in the weeds, and it's slower growth, but it's more meaningful growth.
Yes.
You're not relying on someone on the other end to be truly transparent and ethically aligned with managing the money, and just making sure things are being done to your expectations. It's huge. It's slower growth, more meaningful, but
it's also interesting in the sense that you don't really make any money in it. You make money,
right.
But it's not a profit center at all. It's either a break even or you make a little bit of money, but it's not worth it. Like, that's not why you go into the business. You go into it because the asset itself, that the value in that is so important that you want to make sure that you have your hands in the operations of that. And that's super huge.
Yeah, no, we're protecting the NOI. So anything more you take away from the NOI, you're just lowering the value of the asset. So it is very meaningless to actually get involved. We would never manage for someone else, but manage your own. That's the whole point. Manage your own properties, build your portfolio. That way you can protect the value of the asset. And that's kind of where if you have scattered properties, that's where it's tough to find a property manager at a lower caliber that even understands that. Because they're busy covering their own bills for their own organization. So they have to feed the property in order to pay their bills.
They have, in my opinion, they have their place. And here's some advice to newer investors, right? We ran into a problem, our 28 unit in Houston, Texas it was too small to be property managed by a more professional group. And it was too big to be managed by smaller property managers that were doing single family or duplexes. And so we had a property manager, we ended up firing him because he wasn't very good. And what our local Stefan, our local boots on the ground guy, him and his wife ended up becoming the property managers for 2 years and ran the property. And that was a lot of work, and it was not part of the plan, but that's what we had to do. And so if you're looking at an investment and your plan is to use third-party PMs, really make sure that you've got a plan A, B, and C with respect to other property managers that you can use if your plan A isn't very good or they go away. You don't want to be stuck in a position where you have to take that on if you are not in a position to take it on.
Yeah. If you have somebody living at the property, I mean, that's as good as gold. They know the property, they know the nuances, they know the maintenance requirements, and they're on call. And if you can manage them from an admin point out of your office, I mean, that's your boots on the ground every single day. Put in expectations, the cleanliness, maybe some KPIs, some initiatives, and it works.
Yes.
So you guys got started with property management. So now you're kind of backpedaling, but you're gearing up. You're creating foundational elements to now scale. So tell us what happened thereafter.
Thereafter, we co-GP'd a 96 unit in Augusta, Georgia, with a great friend of mine, Chris. And then that one we got involved with some property management pieces, but that was mostly third party on that one. And that wasn't, we got that during COVID and we sold it during COVID, and that was a good deal. We made money on that. But the next one I would kind of call out was this really unique property on the south side of Atlanta. It was a 60 unit property. It was called Airhaven. And it was owned by the original owner for 60 years. He assembled or built these buildings, and inside each building there was a 200-ish square foot apartment with a bedroom with a bathroom. So it was one room with a bathroom and a closet. And it was supposed to be like it was homes for men. It's weird. Let me describe that. If you were on hard times, right? Or it's like either here or on the streets, or you just got out of jail sort of thing, and you needed a place to kind of like, get your bearings. That was your place. It was $100 a week. So $400 a month. And we bought this in 2019. So $400 a month for rent in Atlanta. Think about that. In 2019, we saw the opportunity there. Number one, the cost basis was so low. It was like 17 grand a door, but it was really run down. But the upside was, we had nearby apartment complexes. One bedrooms were going for 900 and change, and they were all occupied. So there was no product in the marketplace. And our thought process or thesis was like, look, at $400 where they're at right now, if we raised it to 500 or 600, right, it's still comfortably below the 900. That's still a win. And if there's no product for $900, like, we got a kind of captive audience. And so that's what we ended up, we bought it. It was a lot of work. That, we'll call it that market segment. There's a lot of wear and tear on the apartments. There's a lot of drama. It's unfortunate, but it just comes with the territory. It's a lot of work. It was a ton of work. We had it for about 2 years. We sold it for 2.45 million, I think is what we exited for. So we turned 900 grand into 2.45 in 2 years. So it was a phenomenal deal. It was a ton of work. And we had a lot of interesting stories. We had I'm not even gonna go into it.
I know, I get it. You have to manage it with an iron fist, and I totally get where you're coming from.
No, it wasn't even that. Yes, you do. We just people with a lot of problems. We had a woman that was mentally unstable. She was defecating all over the property. This is life of a real estate entrepreneur. Like, how do you deal with a grown adult defecating all across the property?
I believe you. We've had similar stories ourselves, and it's not the end of them. I mean, it's just one of those things. You just you walk in, and people can live a certain way, and it's just.
What's funny is, like, this real estate isn't about dirt and land. It's about people. We're in the people business, and if you, as an investor, you should know what you're getting into. It's not just land, building, four walls, a ceiling, and a roof, as my mentor would say. Like, you're dealing with people that live there. And so the bigger the property, the bigger the complex, the more lives that you have. And think about how complex your life is. We'll multiply that by 50 people, 100 people, 200 people, 1,061 people, right?
Yeah. When you say you're a real estate investor and you're on the LP side, that's the glory real estate. That's like the glorious side of real estate.
It is.
The operating side, the operator, the GP. that's
Oh,
where we're shielding all of that nonsense from the LPs, and they get their passive returns and every month. But it is incredible at times.
why did we get our distribution last month? You don't even begin. I can't even begin to explain what we've been solving for you, but it's okay.
We're working on it. But yeah, that's great. So then, and tell us about your tell us about the deals that you all are working on now, the markets that you're looking at, and then
Sure.
what the debt looks like out there.
Yeah, man, so much. I don't know about you, but like getting into real estate in 2018, 2019, getting warmed up and then getting your first deal in 1920, and then COVID hit. I got in, I don't want to say the worst time, but this has been the hardest time in
Yeah.
all of real estate, in my opinion. So my sense of normal is craziness. So everything has been super hard, super challenging, maybe more than it actually needs to be, but whatever, right? I feel like once I get through this, it's all easy streaming from, from here on out. So the last year, so what we do is we go after larger apartment complexes, 200 units plus in size. For us, that works out really well. We do value add like everybody else. So
Yeah.
we look for apartments that have, I would say, a meaty rent delta. In other words, like their average rents are $200 or more. The more, the better,
Yeah.
under market. And
Hard to find those right now.
it is. So that's what we look for. We like to look for 80s and newer vintages and newer builds. And we focus predominantly on growth markets in the Southeast. So I'm in Georgia, so the surrounding states here. We do some opportunistic stuff in Cleveland. My partner, Matt, is out of Akron. We have a large portfolio of properties in Shaker Heights. So we'll look for things that we can add on to our existing base of operations there. But otherwise, we're looking in Georgia and Tennessee and the Carolinas and all those markets. Last year was a very challenging year. We had a deal that we went after in late 21. We lost it, tried going in 22. With interest rates changing so much so fast, we weren't able to make that make sense and lost a bunch of EMD and whatever else. Last year, we went after a couple of deals. We couldn't make them work like everybody else. We were too apart from a lot of sellers' expectations. And so instead, I just focused the entire year on marketing and learning how to build an investor list and really working on attracting more investors, because it's something that we never did early on.
Yeah, that's sharpening the axe. Like,
Yeah.
Now you can chop down bigger trees, but there's definitely deals that are still hard to pencil. They're softening out there in the marketplace.
Yep.
Just I don't think enough yet. The debt markets. I mean, if you can underwrite it in the cash flows, negative, not negative cash flow, not negative debt, then it works, because you know what it's going to be at in the future. But it's just when you're seeing brokers sell them at a per unit basis, not based off of the current cash flow, that's where it becomes a problem. Because per unit that makes sense, but their existing NOI and then adding back even the expenses that can be added back, it still doesn't underwrite. That's where it can get you can get yourself in trouble. And I think we're seeing that a little bit out there.
You're right, Josh. And the other piece too that I think threw a lot of us through the turn or whatever messed us up here was how much insurance has gone up. I mean, this was a somewhat fixed expense that was somewhat predictable, 3-5% per year, whatever. And then, for some of our properties or some other operators that I talk to, have relationships with, depending on what market you're in, doubling, right? Like doubling insurance is a massive crusher for and you have no control over that. You can't not have insurance, or you can't be like, well, maybe I'll get like the low tier insurance. That's really, really financially irresponsible. So you're stuck. You have like a gun to your head. You got to do it. And I don't know if many investors realize that's a thing that you can't control, but you need it. The bank requires you to have it. It's your fiduciary responsibility to have it, all that stuff. So that's been a hard thing. Property taxes too have been another thing that's kind of can screw things up. It has messed up things for us on our properties.
We just got a letter in the mail. It was literally yesterday, in regards to a property we purchased last year, and it's from a lawyer. It's stating on behalf of the school board. So they're
school boards. Yep.
Oh yeah,
mafia.
yeah. And this is one of the highest tax properties that we've got in the portfolio in comparison to others. It's like, how much more are they trying to squeeze? Because at what point is it just pointless? on a property because they're trying to reassess and reassess.
Josh, I feel like this only applies to operators. What I'm going to tell you now, I don't think I know the people in the school boards, they're doing what they think is the right thing, right? They're trying to grow their budget. I have more resources to teach kids. I get all that stuff. But there is, number one, only so much that you can push these operators. Like, it's a business that we're operating, right? We're also providing housing. And most of us, we add value to the properties that are there. You got a dumpy place. We come in, we make it nice, we make it clean, we make it safe, we make it where people want to live there. So we're improving the quality of life for people who live there, the surrounding communities, right? We're getting rid of the eyesores. Then you come in, you whack us over the head, especially the school boards, with these very predatory tactics, right? Cornering you into an agreement, trying to squeeze more money out. If you do that too much, you're going to dissuade other operators from wanting to go into that area and invest money. And so you're only going to shoot yourself in the foot, because you're going to lower your tax base. You're going to hurt, the population growth going into that area, because there's no place nice to live. Why are they going to live there? They'll go somewhere else. And we're starting to see that now in certain parts of Atlanta, where I have a property in Clayton County. They did like no evictions for like a year. We bought a property in April of 22. It took 12 to 17 months to get rid of people that were not paying rent. They didn't want to work out programs, nothing. I can't run a business if I can't evict people.
Non-payers,
right?
And
when I talked to the local association of apartment owners, they were also agreeing, like, there's a sentiment going on that a lot of operators are thinking twice about investing in some of these growth markets here in the South, because if you don't have these efficient, markets here of getting through the legal process, what's the point? Yeah. So that was my long-winded correlate to your.
That's if you don't underwrite the taxes, though, of what they could be reassessed at. I mean, that could turn a property from positive to negative, and you cannot do anything about it. You can't just go and say lower my taxes. It doesn't work. And this area, do you request an audit of the school board's financials in this area, because it's not going back into schools? And it's extremely high. I mean, it's in comparison, but that's something that we're dealing with now too. And a lot of other operators are as well. But like you had said, that's the cost, the insurance cost here in the Midwest is pretty good still. But we require all tenants to be insured as well on their units. So you've got all of this coverage on top of coverage on top of coverage, and the insurance still goes up. So I don't know. We're trying to figure it out. So
I'm giving you a hug, Josh. I feel you, man.
I just want to cry on somebody's shoulder. But so tell us a little bit about what an investor can expect from you if they wanted to invest alongside of you with one of your projects.
Yeah. So we honesty is one of or open and honest communication is one of our core values in my company. I've been on both sides as an LP. I've been a passive investor. I've been an active investor. I've worked alongside, I would say, not bad sponsors, but sponsors that could have done a better job. So I've experienced those sort of things. We're always trying to learn, seek, and improve on how we can improve our experience working with investors. But what I bring to the table is, because me and my team, we are very well rounded as a sponsor. We're not just a syndicator. We've run our own deals. I've been a passive investor. We are vertically integrated, so we own and control the property management company. We've done a lot of deals before. We've round tripped our deals. We've raised capital before. So we bring a lot of experience into apartment investing that I think you don't really find that too much in the marketplace. We love having relationships with our investors. So, getting a hold of me or anyone on my team isn't mission impossible. Like, we're not a big faceless corporation. And I think the last thing that we're doing is this new venture that I kind of announced end of last month in January, is this ability to have more frequent deal flow. So we have a lot of deal flow, but one deal per month for our investors. We also partner with best-in-class sponsors. We have a very thorough due diligence process to reduce risk for our investors when we do these deals. And we like to bring other asset classes outside of just apartments to our investors. So that could be self-storage, it could be mobile home parks, it could be build to rent. And then partnering with these best-in-class sponsors that have a proven track record and experience just brings more opportunity for investors to invest in other asset classes and put their money to work faster, right? In more diversified manner. So
you're doing it. You're definitely doing it. That's the key is that you guys are vertically integrated with experience. You're not saying that someone else is vertically integrated, but you're not. So that's the key. Somebody's investing with somebody with true experience. I like it. Love it. Definitely appreciate you coming on the show today. If somebody wants to get a hold of you, learn more about yourself, how can how do they get a hold of you?
Yeah, thank you, Josh. So you can check me out at jpalbano.com. That's jpalbano.com. I've got a book coming out titled So Rich You Can Quit. If you want to know more about that, you can go to jpalbano.com/book wait list. And you can sign up for the wait list for that. That'll be out in April. Is my target for that launch.
Awesome. JP, truly appreciate your presence today. I look forward to following you, and we'll certainly talk soon.
Awesome, Josh. Thank you so much, buddy.
Thank you.
Cheers.